Live from Singapore, this is Insight with me, Haslinda Amin, a show where we dive deeper into the stories that matter with crucial context and sharp analysis. President Xi Jinping is heading into China's biggest political gathering, with the economy gaining momentum, though under threat from Donald Trump's plan to increase tariffs. European leaders pledged to increase defense spending and support Ukraine after talks between Trump and President Zelensky collapsed. The Ukrainian leader says he is willing to meet Trump again if invited. Plus, India's economy rebounded last quarter, with GDP growing 6.2%, but economists are still cautious about the future as global trade uncertainties escalate. Asia in the money, kicking off the week in the positive. The MSCI Asia Pac Index in positive territory, up about 0.7% off session highs, though. It went as high as 1.5% on the back of the focus on Ukraine, with Europe saying it is willing to support Ukraine financially, militarily as well, and that's causing the euro to rise as we speak. We also know that defense stocks have been rising on the back of that. In Asia, though, the focus remains on China ahead of the MPC meeting. Expectations are that we'll see more stimulus from the Chinese government to support the economy that's been struggling to reverse course at this point in time. In terms of the CSI 300 index, it is up 0.7%. The Hang Seng also higher by 1.5%. It all depends on what we see this week at that MPC meeting. Won't we see the stimulus that is needed to prop up not just the economy, but sectors like the IT sector as well as the property sector. In terms of the currencies, we're keeping an eye on the Chinese yuan. It is trading higher at this point in time versus the USD. Now, with the US on the verge of slapping new tariffs on China, Canada and Mexico, let's bring in our China correspondent, Min Lo in Beijing. And Min, tell us about the tariffs that are set to take effect.
Yeah, so there is the 25% tariffs that are going to be placed on Mexican and Canadian goods that's supposed to kick in tomorrow, although Trump officials are saying that that final number is still not yet set in stone. So perhaps still some last-minute negotiations going on that could change that final number. We know that Scott Bessent had been signaling that if Canada and Mexico would match the U.S. tariffs to create a sort of North American frontier there, then perhaps they may be able to lower tariffs on Canada and Mexico. So China could potentially be at risk of more tariffs headed its way from both Mexico and Canada. That's on top of the additional 10% tariffs from the U.S. that will kick in tomorrow. It will be midnight U.S. time tomorrow, which will be 1 p.m. Beijing time. So that's when we want to look out and keep our eyes peeled for any announcements of countermeasures from China, because we know that they have retaliated in the first round of that 10% tariffs in February. Pretty targeted and modest sort of measures. Will China continue to adopt this stance of strategic patience? We heard President Xi speaking with Chinese officials, calling them to remain calm and composed amid these external challenges. When will Beijing's patience run out? And it's possible, if they feel that President Trump isn't really negotiating on good faith, you know, he's keeping those tariffs on despite the measures taken by Mexican and Canada to protect the borders, to strengthen security there. If they feel that there is no room to reach a sort of win-win scenario, we might see China toughen their stance. And you got to wonder also what is preventing President Xi and Trump, one of them, from picking up the phone to have that phone call that President Trump had telegraphed that was supposed to happen as soon as possible.
Min, as you said, response has been measured from Beijing. You got to wonder how far it is willing to go, bearing in mind that, of course, the U.S. is a big export market for Chinese goods.
Yes, and China has years to prepare for this. Their companies have already been diverting their goods to other countries, seeking alternative markets in the global south, in Southeast Asia. A lot of the goods going through third countries like Vietnam, eventually reaching the US. So there is this also sense of regulatory catch-up if the US start pressuring other countries to impose tariffs on China as well. And it's not just about retaliating against the US. What will China do to protect or ring-fence its economy by beefing up domestic consumption and building up the resilience there in the face of these tariffs? So to protect against the external environment, they have to strengthen the domestic conditions so that they no longer rely so much on exports. So what sort of stimulus will we see to boost domestic consumption, to go beyond not just that consumption upgrading program? Will they be strengthening social safety nets, giving out more cash handouts to the people who need it, so that people actually feel that they are able and they feel safe about taking money out of their wallets to spend in the economy? That's the big question there. And of course, you know, is China going to still rely on that old playbook of using industrial policy and investments to shore up the economy versus actually transferring that cash to people's pockets? That's what we want to look out for, because the government has pledged that they want to put consumption as a top priority. How much and how aggressive are they going to go with the stimulus?
There's so much room for disappointment given expectations are so high, Min. China correspondent Min Lo in Beijing. Now, the UK has called for a coalition of the willing to secure Ukraine after any US brokered ceasefire as European leaders met in London. Prime Minister Keir Starmer says Britain, France and others will work with Kyiv on a ceasefire plan.
Not every nation will feel able to contribute, but that can't mean that we sit back. Instead, those willing will intensify planning now with real urgency. The UK is prepared to back this with boots on the ground and planes in the air. Together with others, Europe must do the heavy lifting.
And this comes after Volodymyr Zelensky left the White House abruptly on Friday without a minerals deal or security guarantees, following a heated exchange with President Trump.
You're not in a good position. You don't have the cards right now. With us, you start having cards. Right now, you don't. You're playing cards. You're playing cards. You're gambling with the lives of millions of people. You're gambling with World War III. You're gambling with World War III. And what you're doing is very disrespectful to the country.
Well, joining us now is Samir Puri, director of the Chatham House Centre for Global Governance and Security. Samir, good to have you with us. We saw the two leaders speaking on top of each other. Certainly, it was quite a disastrous meeting. What led to that?
Well, very good to be with you. I find it scarcely believable that it's only 2 weeks since the Munich Security Conference, which I actually attended, when I think the dominoes started to fall. And it became very clear that the US policy position with regards to Ukraine was to prioritize above all else the restoration of US bilateral relations with Russia, ostensibly as part of an approach to ending the fighting in Ukraine. But the clear outcome of that is that Ukraine's interests are not of Donald Trump administration's concern. So what we saw in this dramatic, much replayed press conference in the Oval Office was the outcome of all of that. And most interestingly, so the understanding is the retired US General Keith Kellogg, who was supposed to be America's envoy, principal envoy on Ukraine-Russia, potentially advised Zelensky, if you go to Washington, D.C., be very, very aware that this sort of thing might happen. But nonetheless, what we've got as an outcome from this dramatic clash between Zelensky, Trump, and J.D. Vance as well, sitting, as you know, on the sofa alongside, is the strong possibility that if there is a failed attempt at bringing peace to Ukraine, that the Americans can wash their hands off the whole thing and say, well, listen, Zelensky wasn't ready for peace. That's Trump's words. And what can we do about it? But we don't yet know, because it's still a very, very uncertain situation.
What is certain is that the relations have soured somewhat. Samir, I'm going to wonder, was Zelensky really adequately prepared to meet Trump that time?
From the outcome that we witnessed in front of the cameras, you'd have to say no. And I feel a bit for Zelensky here, because imagine what his life has been like over the last 3 years. It's been largely lobbying quite sympathetic, principally Western audiences, government audiences, parliaments, Congress, all the rest of it, receiving standing ovations. If you were prepping Zelensky, I imagine if a diplomat prepping Zelensky before that meeting would have said, you are going to receive the polar opposite reaction to the reaction that you are somewhat accustomed to, flying around the world, making that advocacy case for why supporting Ukraine is in sort of interests of the country that's hosting you. You may actually be cross-examined, and of course, Trump and Vance will play to the crowd of their own domestic US audience, which at a certain level, the US electorate won't be as engaged in the minutiae of what's happening in Ukraine. They'll just see their president talking tough to a foreign leader who, in their president's words, has been basically taking money from the US for no possible end. Now, with regards to Zelensky's performance, questions may be asked, the suit question he was asked, why aren't you wearing a suit? Well, arguably that shouldn't really be part of the discussion. But again, was he adequately prepared for that particular gambit? It's quite, below the belt, as they say, to question him on why he's wearing what he says he wears, because he is trying to sartorially represent the fact Ukraine is in conflict. I would probably conclude he could have done a bit better. I think the big question for Zelensky now is not necessarily what you and I think, it's what happens in Kiev with regards to possible political opponents that he might face in a future Ukrainian presidential election. He might may wish to make quite a strong case that he wasn't able to carry the sympathies or even the attentions properly of the US president.
What happens in Kyiv is one side of the coin. The other side is also what happens to Ukraine-US relations. At this point, relations look like they have broken, and you got to wonder how that can be fixed and whether Zelensky is the man to fix it.
Right, and that's the point, isn't it? There may be voices saying that Zelensky can't necessarily fix it. Now, the other thing with Zelensky is he's gone from this cold reaction and response in Washington, D.C., to a literal hug by Prime Minister Keir Starmer in the UK. So Zelensky has plenty of friends, and I suspect Zelensky will want those European friends, Starmer and Macron of France in particular, to lobby on behalf of Ukraine back into the White House. Now, whether that actually works, as the UK is quite understandably saying it wants to act as a bridge between what's happening in Europe, what's happening with Ukraine, and where the attention spans and sympathies of the administration in Washington, D.C. currently sit. Whether that's realistic, well, we're going to find out. It's going to be a huge test for Keir Starmer and for President Macron, their powers of diplomacy. I'd say the signs are not terrible, given that the US wants to restore relations with Russia so it can actually engage the Russians on this particular issue, which is a stunning turnaround given how adversarial the USA was with regards to Russia for the entirety of the Biden administration. And could we end up seeing a good cop, bad cop approach to Ukraine, as in the Americans play bad cop with Ukraine simply to keep that channel to the Russians open, but the Europeans, led by Starmer and Macron, play good cop. They give that brotherly hug, that metaphorical and literal arm around Zelensky's shoulders, and also offer these credible security guarantees in the shape of a European security force. But I totally agree with your question to round off. There's a huge uncertainty whether Zelensky can actually re-engage with the US president. And the key indicator there is whether the minerals deal, where the US says that would buy effectively their involvement, their interest in Ukraine for the long haul, can be resurrected, can be signed. Right. Zelensky was initially going to sign that. He didn't sign that. He came away empty-handed.
Samir, we're hearing the right things from the European countries, the likes of Germany, Spain, France, even Luxembourg have said they will stand by Ukraine. The question really is, do you trust the extent to which they are willing to stand by Ukraine?
Do you know, I do trust the extent to which the willingness they have. Certainly from the UK's perspective, it's very core to, I think, even British popular reactions to what's happened, which is you don't let the underdog who's been bullied, let them suffer without help. So I know that's more of an emotive case, but I do trust it. Now, where I think the blocks are is even if there is a credible European stabilization, reassurance, peacekeeping force put together, is what the Russian attitude to that is. I just want to reflect on that very quickly. Sergei Lavrov, Russia's foreign minister, said, even if these are NATO countries, don't arrive badged as NATO, we don't want that to happen. And I think there's still an open question as to what the Russians would ask for in terms of the stabilization peacekeeping force. Let me give you a very quick hypothetical. Do they say, yes, France, Britain, Luxembourg, whoever else, you can stabilize from the Ukrainian side? Is there still going to be some kind of desire to get Chinese peacekeepers, peacekeepers from countries that are more sympathetic to Russia, to also be involved? So I don't think we can yet conclude this will be a purely European-led stabilization force, if indeed we do get to the stage where there is a deal involving Russia or Ukraine.
We've spoken about Russia quite a bit in just this 5-minute conversation. It does seem like the U.S. under Trump is trying to strike a different kind of relationship with Russia. How concerned are you about that?
I think if one wants the West to present a unified front against Russia, seeing Russia as the West's mortal enemy, this has probably been one of the worst fortnights of your professional life. From my perspective, I actually served in the Donbass in East Ukraine just 10 years ago in the OSCE ceasefire monitoring mission around that first Russian invasion. I have my own strong views as to, the illegality, the brutality of what Russia has unleashed in Ukraine over the last decade. I also have a realist perspective, which is that sadly, Ukraine was headed to some kind of de facto partition, which is where we're headed towards now. If you take that realist prescription, then you have to talk to Russia in some way, shape or form. And it is clear that under the Biden administration, there was no attempt to engage the Russians in negotiation. There was still this message that you can't talk to the Russians because of the evil heinousness of what they've done in Ukraine. Well, I don't think you can lead a practical policy response to ending this war purely on the moral reaction to this. The moral reaction is very, very important, but there's also an imperative to end the fighting and to bring an end to the destruction. Now, that doesn't mean that Russia should be rewarded, but there is no way to physically dislodge the Russians from 20% of territory they hold in Ukraine and 80% of Ukraine's coastline, roughly, they still also occupy. There has to be negotiations to end this conflict. And Keir Starmer as well has also reiterated his support for Trump's instinct to bring this to an end through negotiation.
We're obviously looking at a pivotal moment in the global world order. It's going to be a changed one. And how should the rest of the world view their relationship with the U.S.? The U.S. obviously no longer defending democracies. How should the likes of NATO, how should countries involved in a Five Eyes arrangement be looking at this?
That's a really good question. I think it's so important to broaden the lens as to how these events in Europe and with the transatlantic relationship are being perceived around the rest of the world. I wrote a book last year called Westlessness, The Great Global Rebalancing, which sort of argued that the trend lines show that the West's position in the rest of the world is changing very, very quickly. And there'll be many more governments and countries and publics around the world that want to forge their own independent views around things. What I say is, on the first hand, countries that have some security dependency on the US's goodwill and its ability to write checks to back their security will understandably be looking at those arrangements with a degree of pessimism, whether that's Taiwan or even South Korea, where there are American soldiers positioned. Of course, there might just be the concern that the Americans will ask for different terms to keep engaged in our countries, in our region's security. That's one part. I think the other part is, this is happening in a world where the BRICS partnership is expanding, where we're still possibly talking about Chinese involvement to help Moscow end this war in Ukraine. And of course, China's view on the invasion was never to criticize it, but it was to kind of play this arm's length role as this economic partner to Russia. All of this, if you'd been Rip Van Winkle sleeping for the last 20 years, is unrecognizable to the world of 20 years ago.
Samir, a related question would be the sharing of intelligence. I mean, how much should countries be sharing their intelligence with the Trump administration, given what they're seeing right now?
Depends which country you're talking about. And there's one news report from about a week ago, which I don't know how true it was that as part of the US-Canada argument, there was some individuals around the Trump administration said we should throw Canada out of the Five Eyes intelligence sharing partnership. That's sort of the Anglosphere countries, UK, Australia, New Zealand as well. Now, who knows whether that's just a bargaining chip in that argument between Trudeau and Trump over Canada's subservience to the US and how much it takes in its security partnership. But let's be really clear, the US has the biggest intelligence apparatus in the world, including its signals intelligence and satellites. So you're not going to turn your nose up at that partnership if you're part of it. It is probably part of how you understand the world, understand threats. I think the possibility of relying on it in the same way, certainly for the duration of the Trump administration, if indeed that part of relationship management becomes a bargaining chip for Trump, that I think is certainly a very, very different world. Whereas I think you would have probably taken your partnership with the US maybe a bit more for granted on the security side in years gone by.
One final question before you go. How should Asian economies be looking at it, especially those who have said time and time again they will not take sides?
It's interesting because the whole they shall not take sides argument is the substance of many meaningful foreign policies. Some experts call that hedging, as in a country is hedging its bets. I think the notion of multi-alignment, in which a country like India or Indonesia, rising power, substantially important economies, are managing their foreign policies with active dialogues towards the Western friends they have, as well as towards China, potentially also towards Russia, in both those examples I've given. That is not an indecision, a failure to choose. That is a substance of potentially very wise and sort of modern foreign policy for this era that we're living through, which is an era of transition where there's still enormous Western power, American power, but there are also rising powers with enormous strategic autonomy and increasingly something to give on the economic side and potentially on other sides as well going into the future.
Right. Samir, thank you so much for your time. Samir Puri, Director, Center for Global Governance and Security at Chatham House. And we have an alert here in response to Trump's additional 10% tariffs on China. China has now responded, according to the Global Times, citing some sources. It says that if the U.S. insists on imposing unilateral tariffs and formally announces relevant measures, China will definitely carry out strong, powerful countermeasures, and that's according to the Global Times, citing some sources saying that it will respond, definitely carry out strong, powerful countermeasures on the back of those additional 10% tariffs. Of course, at this point in time, we've seen how China has been pretty measured in its response. Still ahead on Inside, we'll continue the conversation on the pivotal NPC meeting in China. Hear why Fidelity International's Peiqian Liu expects a higher national deficit to fund fiscal stimulus. Much more ahead. Keep it here with us. This is Bloomberg. And here's a look at cryptocurrencies after a massive rally sparked by President Trump once again talking up his plan for a strategic crypto reserve. Trump's social media post says the reserve will also include other cryptos beyond Bitcoin and Ether, including Solana, XRP, and Cardano. The shout-out helping digital assets claw back some of their steep losses from last month. Well, coming up, investors and policymakers alike are waiting and watching how China will offset the risk of U.S. tariffs while also ramping up fiscal spending. More on Insights coming right up. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. The outlook for China's stocks is being clouded by the tariff threat. This week, traders are also awaiting policy details from China's biggest political huddle of the year. Avril Hong is here with a check on the markets. And Avril, looks like traders are taking the tariff deadline in their strike. Too much optimism, I feel.
Maybe. I mean, the tariff deadline, potential retaliatory action from China, they seem to, for now, be kind of shrugging things off, right? This is the picture on mainland stocks in into the lunch break, CSI 300 Hang Seng enjoying a rebound from the steep losses of Friday, where the week was really dominated by tariff and tech concerns. Today, the bounce is getting fueled by the Tyson manufacturing PMIs, which echo the official numbers in showing resilience in factory activity. So it gives you a sense of the state of the economy that Chinese authorities are dealing with in dealing with Trump and his tariffs. Flip the board again, because as I said, the official non-manufacturing PMI data over the weekend showed the rise. But you look under the hood as well, it shows you how purchasing as well as output prices have, in the past couple of months, actually been picking up. So a sense of deflationary pressures also easing, although there have been some, including the likes of Bloomberg Intelligence, that flag that this might be masking consumption weakness. If you look at services PMI, it actually fell. Flip the board again. If you take a look at the valuations amid the selling of last week, it was really interesting that on many of these indices, they were either around or higher than the 10-year mean. So it was interesting how this held up. Of course, as you alluded to, this week's going to be about the NPC, which some have highlighted does have a tendency to underwhelm, but maybe this time around, given the threat of tariffs, authorities might be spurred into action, Haas.
Your guess is as good as mine, Avril Hong. Thank you. And China's NPC meeting expected to set the tone for China's economic direction and spending plans for the year. Our Chief North Asia correspondent Stephen Angle has more.
This year's National People's Congress will be tasked with some heavy lifting to counter deflationary pressures at home.
Congratulations.
Compounded by political uncertainties from abroad.
We think 2024 was the year of understanding the beginning of reflation in China, but it's going to be a long, long battle.
Coming out of the first Trump trade war and then the pandemic, China doubled down on its industrial policies while simultaneously cracking down on the property sector, the internet economy, and of course, COVID. An over-reliance on exports has led to the challenge China faces today: how to address, without stoking excessive debt levels, the imbalances between industrial overcapacity and slumping consumer spending, while also bracing for a potential protracted trade war.
Priority of macroeconomic policies should shift from promoting more investment in the past to promoting both consumption and investment, with more importance attached to consumption.
Bloomberg opinion columnist Shuli Ren says China's households sitting on more than $20 trillion of savings have hunkered down, spending less and creating their own self-care safety nets. Call it economic long COVID.
I think that's a fatal mistake, because last year, consumption accounted for only 1/3 of the total GDP growth, versus 2018, consumption accounted for more than 2/3. So what happened last year was that basically China managed to grow the so-called 5% only because of strong exports. And that basically put China's economy in a very vulnerable position when Trump launches his trade war.
December's Central Economic Work Conference essentially set the NPC agenda to approve more public borrowing and spending this year, but authorities have been short on specifics.
I think China basically has no good choices at this point, and President Xi has to make some sacrifices.
Including vows to strengthen China's social safety net by boosting healthcare and pensions to an aging society and middle class that's been hit with massive paper losses on property.
I suspect the government will look at the economic development, look at tariff announcement and responses in the economy, and potentially announce more. So basically, I think they need to work hard to stabilize the property market and boost domestic consumption.
The levers for the level of reflation are now in the hands of NPC lawmakers gathered here this week. Stephen Engel, Bloomberg News, Beijing.
Well, our next guest believes China may be able to withstand higher tariff pressures without massive disruptions to its domestic economy. Let's bring in Peiqian Liu, Asia economist at Fidelity International. Peiqian, good to have you with us. Why do you think China can withstand the additional tariffs? We're talking about $1.5 trillion worth of goods.
Thank you for having me today, firstly. And I think that my optimism about China's
ability to stabilize this economy lies under the developments of China over the last few years. If we think about China emerged today as one of the major exporters in the world, yet its reliance on U.S. in terms of exports as a share of its own GDP has been declining. It's telling us that China has been diversifying its export partners as well as deeply integrating the global supply chain. So from that perspective, I think China does have a lot more trading partner to deal with, and that itself is perhaps less disruptive than we previously have envisioned compared to trade war episode number 1.
Even though there's less reliance, exports remain the only bright spark in China's economy, and the U.S. is its biggest trading partner on a single country basis. So surely there would be some impact.
Absolutely. I think that is rightly pointed out towards what China needs to address right now, because China has been, over the years, more reliant on external demand compared to its own domestic demand. Now we're in a pivotal moment. We're all waiting for the National People's Congress this year, this week, more particularly. And I think more importantly, people are waiting for a signal of rebalancing from China, from reliance on external demand more to domestic by addressing the weakness in the consumption and property sectors.
Now, in terms of consumption, that is the big question mark, whether or not China can address that with its fiscal stimulus. How much fiscal stimulus is needed? How much do we need to see to be confident that consumption will be addressed?
I think it's a gradual process. While we do hope that the fiscal stimulus on aggregate term could be more expansionary, we're not thinking about an ambitious target of aggressive expansion. More realistically, we think there will be a gradual expansion that's being addressed by a combination of on-balance sheet budget deficit expansion from 3% of GDP to 4% this year. We also think that central government will more likely be willing to take on the leverage by expanding its bond issuance scope to support consumption. But putting all this together, we're not thinking about flood stimulus like 2008 and 2009, because we're now in a very different scenario. China does have a structural challenge to address too, and those need to be addressed in a gradual manner by a combination of easing and reforms.
But gradual approach has disappointed the markets. The gradual approach has disappointed investors, and hence the market's looking pretty lackluster when it comes to foreign investment in the country. Can that approach still work?
I think we probably need to dissect China's number a little bit more into differentiating where the disappointment comes from. In our view, I think China's real growth has been relatively stable, or if not more optimistic than market has expected. The disappointment coming from the nominal growth that China has not been able to address more directly. So that to us, addressing inflation problem or deflationary pressure is more important than addressing the real growth problem. So instead of looking at numbers in terms of fiscal, which we definitely will focus a lot more on, we are also focusing more on China's way of addressing this deflationary impulse that's coming. So if we look at the inflation number makeup, in my view, I think that supply side has been the main pressure that's been weighing on both PPI and CPI. We have seen moderate improvement in demand, and I think that's going to continue. But more importantly, I think China needs to address the supply side problem of the issue as well. So more of a rebalancing.
So you're seeing that the deflationary pressures are easing at this point in time?
It is easing because domestic demand has been picking up gradually, but supply side remains a pressure for the domestic inflation pictures. So we think that China needs to address both sides of the problem, supporting this domestic demand while continuing to address the supply side issues with reforms.
Consumption is also being hampered by what's happening in the property sector and lots of expectations of what China can do to help ease the pain in the sector, which has gone on for some time now. What can China do?
I think for consumption, it boils down to two factors that drives consumer sentiment. Firstly is the wealth impact, which inevitably lies to the stabilization of the property sector, because household has been suffering a lot of paper loss on the property sector over the past few years. So I think that direction of stabilizing property sector and equity markets is a right direction to travel. We need more policies coming up from this side. It might be incremental, but stabilization helps restore household confidence.
What policies would work?
I think for Chinese government, they're right now focusing a lot more on addressing the excess inventory issues in the property sector. So this year, in terms of more details in the MPC, I think we're looking for optimistic case. China allows the local government special bond issuances to be used for addressing such issues that could accelerate the pace of local government addressing the excess inventory.
So destocking is what we're looking at for measures to help that. The other thing that the market in particular is looking at for are pretty much stimulus for the tech sector, in particular AI. We've seen how the rally's been driven by the tech plays, including the likes of Baidu, Alibaba and Tencent. What can be expected there?
I think the tech sector outperformance in the recent weeks is one of the hopes or optimism that we have on China's fundamental, because that is happening under the backdrop that the regulatory environment has not yet changed significantly. I think President Xi's meeting with the private sector carries a lot of significance from that perspective, because that just tells us that the policymakers are now going to be more supportive of this sector. So that's a tailwind to the development of this sector. Private sector probably does not need aggressive fiscal support, but accommodative or supportive regulatory environment could play a bigger role than fiscal stimulus to drive the growth of this sector.
We've been talking about how we want to see greater stimulus from China. How much capacity does China have in providing the stimulus that we want to see? It's kept its powder dry for some time. When will it see the need to deploy that dry powder?
I think from our perspective, I think MPC used to be the most important meeting of the year because it sets the various targets with policy supports. But we have to visualize that the global geo-economic landscape has become much more fluid. So China's policy making will most likely to become more dynamic as well. There are definitely more dry powders that China could be deployed in extreme conditions, but we have to think about China's policy making in a more reactive way. So we think meetings in April, July, October are equally important for us to watch out for.
All right, we're watching out for a lot then, Peiqian. Thank you. Peiqian Liu of Fidelity International will be staying with us to offer her views on China this time. Well, U.S. Treasury Secretary Scott Bessent says that if tariff is President Trump's favorite word, then reciprocal is becoming his second favorite. We asked Bessent specifically about plans for levies in China due to double on Tuesday from the current 10%.
We will see where the tariffs finally end up. The China tariffs, since they were put on, have brought in substantial revenue. They continue to bring in substantial revenue. President Trump has talked about reciprocal tariffs. If tariffs are his favorite word, I would say reciprocal has gotten to be his second favorite word. And in the reciprocal tariffs, you actually don't know the path of what's going to happen, David, because the idea there is that if Europe has a 12.5% tax on our cars, we could either put a 12.5% tax on theirs, or the tariffs could get dropped altogether. So it's going to be very path dependent, but I would expect that with the 10-year scoring that the CBO likes to use, that there could be substantial tariff income over the next 10 years.
When we look at tariffs, there's a lot of different things being talked about, proposed, threatened, even imposed. One of them is Mexico, which comes up next week. Is it important to get the revenue from the Mexico tariffs? Because I know Mexico is sort of moving, it appears right now, for example, with respect to tariffs on things coming into Mexico from China. Can they get off the hook on tariffs?
So the tariff negotiation isn't under the purview of Treasury. It's USTR, U.S. Trade Representative, and Commerce. So I'm going to leave that question to them. I do think one very interesting proposal that the Mexican government has made is perhaps matching the U.S. On our China tariffs. I think it would be a nice gesture if the Canadians did it also. So in a way, we could have Fortress North America from the flood of Chinese imports that's coming out of the most unbalanced economy in the history of modern times.
And that was U.S. Treasury Secretary Scott Bessent speaking with Bloomberg's David Weston. And we have some news out of the Oscars. Anora winning Academy Awards for Best Picture. And of course, we'll bring you the other winners just very shortly. Anora winning the Academy Awards for Best Picture there. Well, I haven't watched it, so I can't really judge on how that went. Well, still to come. India's economy rebounded last quarter, but economists remain cautious amid global trade uncertainties. More on the outlook next. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. India's economy rebounded last quarter, offering some relief to Prime Minister Narendra Modi, whose ambitious growth plans have come under pressure. GDP grew 6.2% in the 3 months to December, thanks to a pickup in government spending after the national polls and strong rural consumption. Growth is expected to reach 6.5% this year and remain below 7% next year due to external uncertainties and weather-related risks. Peiqian Liu, Asia economist at Fidelity International, is still with us. So an improvement, but whether or not that can be sustained, that's another story.
Yeah, I think for India, it's the stabilization is temporary, perhaps, because from the broader backdrop perspective, I think fiscal is consolidating this year after the elections, and we do see inflation remains at relatively high levels, even though it's coming off its peak from October last year. Real rates remains high, and wage growth is not yet picking up or accelerating. So all these combination of factors just tell us that India still needs a lot more support, both from fiscal and monetary perspective.
And when it comes to activity, it's still below potential. When it comes to support, what's needed after the budget that we saw?
I think that policy needs to rely back more on the monetary. So if we think about inflation coming off gradually and that domestic demand is not yet picking up strongly, or cyclically they're actually facing a lot more headwinds, external uncertainty remains in the air, and also that, you know, with the tariff policies being very uncertain, I think RBI needs to pick up its pace of rate cuts going forward.
So given the expectations of rate cuts by the RBI right now, is that sufficient? Or it needs to be more aggressive in cutting rates this year?
Well, in our view, I think in order for India to remain close to its potential growth, we do think that the market consensus of RBI's rate cuts this year has been at 50%. We are a little bit more dovish and thinking that RBI perhaps needs to do more in terms of the monetary policy support. And also given its uncertainty from external environment, the RBI needs to also be more dynamic and responsive.
The problem is the RBI is caught between a rock and a hard place. If it cuts policy further, then we'll see a further deterioration in terms of the Indian rupee, which is already hovering at record lows. So what does it do? Where is that fine line where it can balance both?
I think it's a case with all the Asian economists, to be honest, Haslinda. I think if you think about the trade-offs between FX or financial stability compared to domestic demand support, all the Asian banks need to make a choice between where they draw that equilibrium. More particularly for India, I think in the very short term, the RBI has been kind of signaling to the market that they're willing to let rupee depreciate a little bit more to accommodate the pace of monetary easing. So I think that's dynamic going forward. It's really hard to say where the fine line is, but definitely all the central banks in Asia are trying to achieve this balance between fiscal FX stability as well as supporting domestic demand.
And that's without adding the risk from tariffs likely to be imposed by the Trump administration. We know that reciprocal tariffs are coming, and India could have it bad when it comes to that.
When we think about bilateral reciprocal tariffs, yes, India is higher on the rank in terms of the tariff rates that potentially could be imposed. But we also recognize that this is a broad-based tariff increase across the Asian economies. Of course, there are different magnitudes and scales of such tariff rates. But from an FX perspective, I think that India is just trying to let go its currency if the rest of the peers are doing so.
So where do you see the Indian rupee trading by year end?
We don't have a point forecast, Haslinda, but from a direction perspective, I think FX will likely to be used as one of the policy tools to offset that tariff pressure that's about to come. So in terms of tariff and our expectation of FX, it goes in the way that if tariff risks are higher, it's more likely that FX depreciation is going to come.
Have we seen peak growth in India already? Will we not go back to 8% growth in the country?
I think from a cyclical perspective, we do not really have that kind of optimism because we do see a lot more cyclical pressures. But in the long run, I think never say never, because India does have its potential in terms of demographics, structurally favorable policies if they continue to support CapEx as well as the manufacturing sector. So the trajectory really has huge potential. And we probably come back in the next cycle thinking that it could reach a higher rate.
Are you more optimistic when it comes to growth? India versus China, which country is likely to do better this year?
That's really a hard pick because we all know that for China's growth rate at real GDP terms is actually lower than where potential growth for India is. And they're facing very different sets of growth challenges as well as opportunities. So for India's term, we're not comparing apples for apples, but I think India's domestic demand remains the main growth driver, and that's what China needs to focus a lot more on as well, to pivot into domestic demand.
Peiqian, thank you so much for your time today. Peiqian, you are Fidelity International. Let's do a check on some of the stocks that we're tracking here on Bloomberg. Seven & I, CEO Isaka is set to step down, and that's according to the Nikkei newspaper. We're talking about Ryuichi Isaka. The CEO is stepping down from his position, according to the Nikkei newspaper, reporting without citing any sources. And we're told that Stephen Deckis, the board member leading a special committee evaluating a proposed takeover by Canada's alimentation couche-tard, will replace Isaka, and that's according to that report as well. Currently, 7 & I trading up by about 1.6% on the back of the news. Taking a look on how those bubble tea giant Mixed Shoes is doing. It's surging after Hong Kong's biggest IPO of the year. Take a look at that. Wow. A surge of more than 40% as we speak. This is China's biggest bubble tea chain. Investors flocking to its $444 million IPO in Hong Kong. That jump, it's in excess of 40% right now. And of course, this is a day where we're seeing broad gains in Asia. The MSCI Asia-Pac Index in positive territory. That's on the back of investors focusing on Ukraine, because Europe has talked about supporting Ukraine on the back of what Trump said over the weekend. Before we go, here's a look at tomorrow's show. We'll discuss the Bank of Thailand's rate path with Assistant Governor of the bank after their surprise cut just last week. And Eastspring Investment will be sharing their outlook on markets. Keep it here with us. This is Bloomberg.